In the last almost 3 years, equity stocks or equity funds have given us poor returns. With so much of volatility, less returns, what is the next best set of funds? And within that category, which is the best fund? And that's what we're going to do today. We're going to talk about one type of hybrid fund. This is a category that will surely appeal to you. You will want to have it in your portfolio. And that's what we're going to do today in this video. Hello, I'm Franky Fernandes. I'm a certified financial planner. I'm a founder of Harmony and Money, and my goal is to help families, young families, grow their wealth without sacrificing their relationship. So let's get into today's interesting video on that one hybrid fund, which will really give you good insights in today's analysis. So let's get into today's video. So let's begin this video with an analysis of various fund categories from Jan 2024 to April 2026. We are right now in April 2026. And why have I chosen this period? From Jan 2024 till April 2026, we have seen a lot of volatility in the stock markets, both BSE and Nifty. The markets were around 73,000 during in Jan 2024, and then it reached the peak of 85,000, 86,000 in August 2024, and then it fell in 2024, 2025 early, and then 2025, the second half of 2025, it started going up, and in November 2025, it reached the peak again, and then again from 25 to 26, for various reasons, the tariffs and then the Iran war, we have seen the fall. And during this fall, I want to show you all the different categories of funds. What would have happened if you had done an SIP or a lump sum? And what are those categories? Large cap, mid cap, small cap, flexi cap. Then I've also compared it with the hybrid funds, which don't give that performance like the equities, but there is stability. Returns are low, but there is more stability. So what I've compared is aggressive hybrid, balanced advantage, and equity savings. Now these three hybrid have a decent amount of equities. That's why I've included in this. As I mentioned, they don't give great performance, but there is stability. But we will see in this period, if you had done an SIP, what would have happened. And towards the end, I'm going to explain to you what is the purpose to compare this, how it can help us in investing for short term, medium term, and long term. So let's get into the analysis. So here is a spreadsheet where I have actually pulled data for SIPs, and also I'll share the lump sum. So here we have large cap, mid cap, small cap, flexi cap, aggressive hybrid, balanced advantage, equity savings, and we have a summary too. Now, here is a large cap. I've taken the top 5 funds for each category, and I've pulled their the SIP data. So the SIP starts from 15th Jan 2024, when the NAV was 64. The NAV went up to 79, and then again the NAV went down, and then the NAV went up again in 2025. Again, it went down to around 75. So see the movement. And these 5 funds I have taken here: Bandhan, BNP, HDFC, Prudential, ICICI, and Nippon India. So disclaimer: these I'm not recommending them to invest. This is just for the purpose of analysis. I'm using them. And what is the SIP returns? That is annualized returns, right? Compounded returns. It is 3.82, 1.9, 0.75, 3.37, 3.86. So average around 2.74%. So this is the SIP return for large cap. Now let's be quick here. For mid cap, the returns are 8.97. This is annualized returns again. So in the last 2.5 years, so if you look at the data, 8.97, 8.07, so 10, 10.13, 8. So around 9.23 is the average of all these 5 funds. Again, if you see here, the NAV 74 went up to 101, now it is back to 101. This is after the ceasefire was announced. Small cap also good, but the one is 8.7.9, 5.6, and 3. So there is a variation between the funds too. The NAV again 34, it went up to 48, went down, and now again it is 45. It has not reached the peak yet. Flexi cap, now here it is, one is minus 2.23, Bank of India 6.89, 4.3, 5.06, and Parag Parikh 5.31. Redo small cap again. So here we have small cap where the average is 6.32 percentage. Flexi cap, we've got 3.87 percentage. Aggressive hybrid, 4.38. Balanced advantage, 4.77. Finally, equity savings, 6.87. So let's take a quick look at the average and compare all the averages in the summary. So here we have the funds, the mid cap, large cap, small cap, balanced advantage, equity savings, aggressive hybrid. Now, what is the surprise here? Number one is mid cap. Mid cap has done extremely well. But number two is not an equity fund, it's a hybrid fund, equity savings. So, number two is equity savings. Number three is small cap. So, equity savings has even beaten small caps. Number four is balanced advantage. Number five is aggressive hybrid. Number six is flexi, and number seven in terms of the average. Now, the reason I've taken average is because a lot of those funds will reflect this. So, what we see here is a very surprising element of performance when you compared equities and hybrid in this volatile scenario in the last 2.5 years. And the surprise is equity savings. Now, the better part of this is that equity savings is much, much less volatile. If you look at the NAVs, I'm going to share with you, it only usually keeps going up. The volatility is very low, standard deviation is low, but compared to mid cap, now mid cap is number one. The returns are higher, but it has been very volatile. And in the middle of the war, if you had seen, it would have been much low. So basically, what it is saying is that equity savings gives you a very good return in volatile markets without losing your sleep over this. So what is the time horizon you should have for an equity savings fund? What is the outer limit? What is the minimum period that you should stay invested? That I will cover in the last section of this video. Let me share with you why it was volatile. So if you see here the NAVs from Jan 2024 till April 2026, see how equity savings has gone. Just like a debt fund, a fixed deposit. But if you see here mid cap and small cap, see the volatility. Which means if at this point or this point, if you had seen your investments, it would have fallen, crashed. And that can take away your sleep and can give you nightmares, but not equity savings. Now let's take a look at what it has returned in terms of lump sum. What if you had invested 10,000 in Jan 2024? What would be the returns right now? What would be the compounded returns? So now let's take a look at the lump sum investment. What if you had invested 10,000 rupees in each of these categories in the best fund? And what returns would it give you? I'm not taking the average to keep it simple. So if you had invested in mid cap fund, 10,000 rupees in the best fund, you would have got 14,176. And then large cap 11,913, then small cap 13,403, so forth and so on. Now, again, the surprise here is that number one is mid cap. Here, number two is small cap, but number three is equity savings fund. Both in the SIP and the lump sum category, these three are on the top. But remember that small cap and mid caps are highly volatile. They go up and down. So in the middle of the war, if you had seen this, I have seen this, I have the data, equity savings was number one. I had planned to do that video during the war. I missed it. But then I thought, let me now try when the markets have gone up. Does it still hold water? Does this fund still do well? And if you see here, it has done well. It is number three. It has even beaten its peers in the hybrid category, that is aggressive and balanced. Now here, if you see here, balanced advantage was number 4 in SIP. Aggressive hybrid was 5. But here, when you see the lump sum, balanced advantage is last and aggressive hybrid is 4th. So in the SIP and lump sum category, there is an interchanging, but equity savings has remained in the top. So, what is the secret ingredient of this equity savings? And that's what we will do in the next couple of sections. What is this equity savings? And what is the sweet spot for this period for this category in terms of the period? So, and which kind of investors does it suit? Let's look at the next section. So, what are these equity savings funds? So, equity savings funds is equity savings funds typically invest a minimum of 65% of their total assets in equity and equity related instruments, including arbitrage, and 10 to 35% in debt and money market instruments. This structure combines equity exposure, arbitrage, and debt to provide capital appreciation with lower volatility. Let me explain. So basically, 65% of it is equity plus equity related, which means hedging. And what is hedging? Hedging is it's like buying in the cash market and selling in the futures market. So basically, the fund manager buys a certain stock in the from the spot market, the cash market, where we usually buy and sell, and at the same time, it sees an opportunity in the futures market, probably the futures market where the price is higher. It sells and makes profit. Let us look at an example. For example, here is an example of company X. The spot price is 500 rupees in the cash market, and the future price of the same company is 510. So what the fund manager does is buys 10,000 shares at 500 in the cash market by paying 50 lakhs, and then it sells 10,000 shares in the futures market at 510. Basically, it identifies an opportunity of this price difference. So the fund locks in a gross profit of a lakh rupees before transaction costs. Now, whether the share price in the cash market goes up or down doesn't matter. The fund manager, the fund has locked in this at this price, which means it gains 1 lakh in the when the it gains 1 lakh at maturity. So this is the way the fund makes money, through arbitrage. So it has some portion of equity which is unhedged, so that it can actually produce returns. Then that within that 65 percentage, you've got a lot of arbitrage, which is like uh, guaranteed income it gains, and then around 35% of the debt. Debt is for stability. Purely, it gives you income. So by doing this structure gives an advantage to the fund. It appears like an equity fund. And so it is taxed as an equity fund, which means less than 1 year period, it's 20%, and more than one, that is long-term capital gains, it is 12.5%. So it becomes an equity fund. Compared to a debt fund, if you make profits, you have to pay at your highest income tax slab. So here there's an advantage of an equity fund. So this is the way an equity savings fund works. And this is the reason why there is low volatility, because of 35% of debt and a large portion into arbitrage. There is just probably 10-15% is into actual equity. So this fund, compared to the balanced advantage fund, which is slightly more risky, and the aggressive hybrid fund, which is far riskier. Now, if you think all these three funds can be compared, let me know in the comments if it is worth making a video on comparing these three funds to know which is the best fund in terms of returns, volatility, stability. In fact, so now let's take a look at this last segment, which is rolling returns. What is the safe period for equity savings funds? Which means that it almost guarantees you some returns. Let's take a look at this. Before I share about the rolling returns, let me quickly explain what is rolling returns. I have made similar videos on rolling returns for large cap, mid cap, small caps, flexi caps, and aggressive hybrid. Basically, it tells us what is the threshold, at what point it starts giving you returns. That means minimum, this is the period before which there is no guarantee of positive returns. And rolling returns is basically you take a certain period, for example, 10 years, and you take 1 year, 3 year, 5 year, and any number of years rolling returns. 1 year rolling return means, from example, 2016 April till 2017 March is 1 year. Then 2016 May to April is 1 year. Then June to May is 1 year. So this is the way rolling returns is checked. Same way for 3 years, 2016 to 2019, 2017 to 2020. So 3 years, 5 years. By this, what you're trying to accomplish is, in any given 1 year, 3 year, 5 year period, what kind of returns a particular fund has given. And that tells us whether such funds in the future, there's a probability, not guaranteed. Probability is that whether in the future we can expect a certain same behavior. So we look at equity savings funds. So here is 1 year rolling returns, right? 1 year, and this is from period of 2016 to 2026. So here it tells us basically, and I think the main number is here, and I think this is what we have to see. So in 1 year period, how many times it has given negative returns? That means with so many different various combinations, right? So many various combinations, number of hundreds of, iterations. It shows that some funds have shown 16.61, some 6.57. So on an average, some of these funds average 8% of the times it has given negative returns in 1 year returns. Obviously, for example, now if you see the last 1 year, from May 25 to April 26, definitely the markets have gone up and down. So probably it has given negative returns. And average, roughly 44% of the times it is given 0 to 8% returns, and around 23% of the times it is given between 8 and 12%. It is also given more than 12% in 1 year period, around 23% of the times. It has given positive returns of 12%. So this is the possible. So that means there is a probability that you can get negative returns. So 1 year is not an ideal period. Now let's take a look at the 3 year period, 3 year rolling period. So what does it show here? 3 year rolling period average, that means less than 1% of the times it has given negative returns. But otherwise, most of the times it is given more than, from 0 to 8%. That means 40% of the time 0 to 8%, 50% of the times 8 to 12%, and roughly 10% of the times more than 12%. So this is the sweet spot of equity savings. Now, if you look at 5 year rolling period, it's most of the fund, it is 0. That means in 5 year period, you will never get equity savings negative returns. You will ideally get 0 to 8%. That means 36% of the times it is given 0 to 8%, 55% of the times 8 to 12. That means there is a high probability that you'll get between 8 to 12%. And there are chances that you might get around at least 8% of the times about 12%. It depends on the which fund you have purchased. So if you look at equity savings funds, 3 year seems a very reasonable period. You can get high returns in 1 year also, 2 years, but it is not so much guaranteed. There's a high probability that you will get positive returns and good returns in a 3 year period. So what does this really mean? Low volatility, good returns, decent returns, 8 to 10% or so, even more we have seen. But the best part is that if you want to invest for 3 year horizon, get advantage of an equity fund, taxation as an equity fund, and a high probability that you will never get negative returns, equity savings looks like a good fund. Of course, all this is educational. Please consult your advisor before you make purchases. But this is a fund that can help you actually stay calm and cool even during the volatile period like this war. In fact, if the war continues probably, and if there is this volatility in the next few months, your equity savings funds will continue to remain strong and stable. So my strong recommendation is that this is a fund that you can invest and get decent income up to 3 years without worries. Before 3 years, there is no guarantee, because we have seen that in 1 year period, it has chances of giving you negative returns. 2 years, I do not have the data, but 3 year data shows that it is just the right period. So hope there is some new understanding about this wonderful category where actually you can peacefully invest if you have a time horizon of around six time horizon of around 3 years and you want to get better returns than a debt fund. If the markets are great, markets are good, you can even get about 10 and 12%. That's what we have seen. But even when markets are bad, there is a downside protection because of the debt and the arbitrage, which gives you an advantage. So you can actually peacefully, you can peacefully actually, you can stay calm and have peaceful nights. So hope you like this video. Please let me know in the comments. Give me a thumbs up. And if you've not subscribed to this channel, please subscribe and enjoy such videos on basic concepts and financial literacy about primarily about mutual funds. Thank you for watching this video till here. See you soon.